now request Dr. Rao, our immediate past president, to welcome the gathering and address the keynote.
Good evening. Good evening. Come on. You don't have a voice or what? Huh? Just in the evening itself, you're already lost. Come on. Good evening. Good, good. That's something like it. I take this opportunity. It's a great pleasure for me to invite all of you. I do see quite a few charter members and institutional members into this masterclass and associate members in here. We welcome all of you from the TiE Mysuru. Typically, when a startup is going through its initial phases, you'll be looking at trying to say that, my startup has a wonderful idea and the value of my startup is in millions and whatever, right? That kind of money valuation you will see. Today, somebody is going to talk about and explain to you, Neha, right? She is going to be explaining to you how exactly they calculate your value. What is your idea? How do we put a value to that? That is the starting phase for your startup to say that, yes, I have some value. Now I can raise some funds. I can be sustainable from some perspective. And Mahit is going to be talking more about the legal mechanics, meaning that, how do I make my entity legal enough for me to raise the funds, various other aspects of it. So today we have a new institutional member who has joined us, 10X, and I see quite a few young kids. They are most probably 9th, 10th standard. Maybe I'm wrong, but okay. They are shaking their head and saying yes. So we are bringing them young and we are training them to be entrepreneurs for the next generation. Entrepreneurship is a difficult journey, to say the least. If you go to your job, somebody tells you what exactly to do from the morning till evening, and you are done at the evening and you go home. In entrepreneurship, there is nothing called morning to evening and somebody defining your job. You are the entrepreneur, you are defining your job, you are trying to say what you need to get done. And sometimes you have nothing much to do, sometimes you have a lot to do. That's the way it goes. Okay? So, from that perspective, for 10X, it will be a good journey to change the mindset. Instead of being an employee, can I be an employer? That mindset change takes a lot. Lot of support from parents, lot of support from the society, from the people at large, along with your own mindset saying that, yes, I want to be an entrepreneur. The fun of that is when you are going through the journey, you will see a lot of fun, lot of experiences. You cannot just explain it. You have to live it, you have to understand it, you have to go through it. Okay? So, with that, I'll just say that I will hand over the stage to the two expert speakers today. Unfortunately, I can't be here till the end because I have another engagement at 6 o'clock, 5:36 in the Lions School where I am in the governing council, their school day. I have to go. But I'll be here to listen to certain parts of it, and then I'll be taking leave, so I'll be sitting in the back so that I won't disturb. But good luck, Mahit, good luck, Neha, and thank you for accepting to come here and do this masterclass for us. Thank you so much. And again, welcome.
Welcome to you also, sir. Okay, now I have the privilege of introducing our speakers for today. First, Mr. Mahit. He is a partner at GameChanger Law Advisory. He has more than a decade of intensive experience in corporate advisory, commercial contracts, sports law, and social enterprise law. Mahit has represented clients on transactions in technology, education, health, sports, and social impact sectors, which stands as a pioneer to his versatility. He has managed many mergers, acquisitions, venture capital investments in India, notably representing a top UK-based impact investment fund focused on edutech and agritech sectors. Mahit is dedicated support to the startup ecosystem, often facilitating legal workshops and individual sessions at leading incubators and ecosystem players. Mahit provides legal advisory service to all the portfolio companies of the YSB Bangalore. He is also a former third division football club player. Mahit has also provided specialist legal assistance to leading Indian football clubs on various contracts and governance issues. Mahit has pursued his law from Christ University, Bangalore, with a BA LLB in the year 2014. And about Neha Prasad, she's an associate partner at Qapita, a chartered accountant by profession, again, more than a decade of experience in management consulting, advisory of equity-based compensation plans, options, accounting, legal drafting, and business valuations. She expertises in presentation and interaction with CXOs, CEOs, and board of directors for various prestige entities. She is into managing team consulting and valuation. So I don't know, I was very fast telling it. Okay, now the stage is all yours. You have time till 6:15, 6:20. We are hoping to have an engaging session. Thank you. Please.
Mysuru. So this is the first time I am in Mysore for such kind of events. Earlier, it was always a fun trip with family. But good to see, I mean, these kinds of events are happening in Mysore, and I came from Bangalore. So last year I was part of the TiE Global Summit in Bangalore, which was huge. So I wish we'll have similar kinds of events, TiE events in Mysore soon, and especially with all the news of people and the companies migrating to Mysore because of traffic and other issues in Bangalore. I think that will happen sooner than we'll think of. Fine. Oh. Yeah, of course. It also reminded me, yes. Correct. So, I am going to talk about valuations today. So it's a mixed group, so I'll try to keep it simple, but if at all you feel like I'm going too technical, please stop me and you can ask what is, that term stands for. Before we start about valuations and startups, I'll just take a moment to tell you about my organization. So I come from Qapita, and at Qapita we believe in unlocking the power of ownership. So basically we are into advising for the equity compensation transactions. We support our clients. We have supported more than 2,400 clients abroad and in India. We have presence in Southeast Asia and US. And we support them right from, structuring the ESOP plans and then supporting them on our platform for exercising grant, then all the compliances, and also also there's a marketplace wherein we enable the liquidity for all the option holders. So these are some of the esteemed clients on a screen that we have worked for. Fine. On the valuations. So about valuations, well, I'll start with a very basic question. I don't know if sometime maybe, you must have argued with your friends that, this movie ticket this weekend, it seems to be too costly. I mean, it's not worth it. Let's wait for, another weekend so that the price goes down. Or maybe you have seen a price tag on, any dress that you liked in a mall, and you said, oh no, let's wait for the sale to happen. It's not worth it. Has it happened? Is it? Yeah? Or otherwise also has happened, right? If you are eagerly waiting for a movie, right? So then you, yes. So I was talking about various scenarios where you must have felt that this is the value of this is not, worth it. You're not willing to pay a price, right? So that value is what we are going to talk about today, right? So it's a very famous, there is a saying from, a very famous investor, Warren Buffett. I don't know if you've heard it, that price is what you pay and value is what you get, right? So today I'm going to talk about valuations from a startup perspective and what it means for a founder. So imagine a founder who has put in his heart and soul and, he's put in a lot of work in building a company, right? And then it all boils down to what is the value of the company. How much, money the VC or a PE is going to put in. It will all depend upon the valuation of the company, right? So in order to determine this valuation, there are a lot of methods that is being used, right? Then the objective of a founder will always be that you value his company as much as possible, right? He will want the valuation to be, he'll always have a prejudice about the valuation. He'll say like, maybe 10 crores or something like that. And the VC will say like, no, I don't want this much valuation. Maybe I want to get the shares cheaper, right? So he'll say maybe, it's not worth it. It's around 7 crores or something. And then you would need a third party, an independent valuer, to come in and give you a value which is independent and which is not influenced by any kind of a bias. So that is the role of a valuer. So most of the time the valuer is, he is negotiating between what is the expectation of a founder about his company. He has to also manage the regulatory compliances. He has to look at the models that he is going to use, the methods that he is going to use. And then the other party is investor, whether the investor is ready for that kind of valuation or not, right? So valuation is much more than a model or the guidelines or the expectations of a founder. It is all about judgment, okay? The judgment of a valuer. So he has to practice a lot of judgment which goes beyond the methods that he is going to use. He has to look into the, a lot of things like what's the growth prospects, what are the plans of the company, what kind of industry is the company operating in. So there are a lot of factors that the value has to understand in order to derive a value for the company. Right. So you can see, like I explained you about what is valuation, why is it required. So most of the time it is required for a fundraise whenever there is an investment happening. So then you would need a valuation report or a valuation at which the shares will be transferred to the investors and investor will become the shareholder of the company. Then M&A, mergers and acquisition, to negotiate a good deal. Then ESOPs. How many of you know about ESOPs? What are ESOPs? So, employee stock options, okay. So whenever there is a stock option grant, then there is a requirement of a valuation report. So why is it required? Because unless you understand the value of equity shares of the company, you will not be able to give a stock option, because for a stock option, the underlying asset is a equity share, right? Then comes the regulators. So there are a lot of regulatory compliances in India around valuations. So there are multiple regulatory authorities like SEBI, there is IBBI, there is RBI, then there is regulations in the Companies Act that demands for a valuation report, because they want to ensure that there is a fair play. There is no transaction is happening which is not fair or which is not correct. So they want to see whether everything is compliant. So a lot of valuation reports are just for the purpose of meeting these regulatory compliances. Then there is internal planning also involved, because you need to allocate your resources according to where your value is derived mostly from. Like, let's say, there is one division which is giving you a 70%, value to your company. So you will definitely allocate more to that particular division, right? You will be allocating more resources to that particular division. Uh, so about valuation authority requirements, I spoke already about the various regulations under which the startups would need a valuation report. So these are the various regulatory authorities. So a registered valuer is registered under IBBI. So most of the time when we are talking about a valuation certificate, it is mostly we will need a registered value certificate. Like for ESOP grant, you will need a registered value certificate, right? Now merchant bankers are SEBI registered merchant bankers. So whenever SEBI requires a valuation report, it will be through a merchant banker. So like Qapita is a category 1 merchant banker. Then there are chartered accountants under income tax, and there are other regulations wherein the chartered accountants can also issue a valuation report. Right. Now it's there's a whole big universe of valuation. I'll give you a glimpse of what it means for all the stakeholders. Like we already spoke about the founders. They would always want their valuation to be they will also always want to fetch a higher valuation, because it will mean that they'll be diluting less. So let's say a founder wants to dilute 10%, right? So if he is getting a higher valuation, he'll be diluting less. Whereas a VC will always want, an investor will always want to get it cheaper at a lower valuation. Now, if you think of valuation, like if it is for the regulatory compliances and it is, let's say, for cost booking, you will always want your valuations to be at the lower end, right? Right. Now there is some maths. Let's understand some of the maths around how pre and post valuation happens. So let's say there is a value of the company, which is wherein there is no investment has not happened, right? So the pre-money valuation means there is no investment has not happened, right? And then post-money would mean that after investment, whatever money has poured in, that will add up, and that will be your post-money valuation, right? Now, what happens is that the VCs would always do a calculation about the dilution on the post money. So let's take that example of a 10 crore investment. A pre-money valuation of this company is, let's say, 40 crores. There is an investment plan for 10 crores, and the post-money valuation comes to 50 crores, right? Because we'll add 40 plus 10, that is 50. That would mean that after the investment has come in, that 50 crore, the dilution for the investor, for the founder is around 20%, and for the founder, now his stakes has come to 80%, right? So you can see the dilution comparison table also, how this pre and post money works, right? Post money will always determine your dilution. So let's say if I have to invest 5 crores for 25%, what is the pre-money and post-money valuation? Can anyone answer? No. 5 crore for 25%. Yeah. A lot of students, please do the maths. Work backwards. Use your calculators. So it is like I want to invest 5 crores, okay, for 25% of stake. Okay, so what's my pre-money and what's my post-money valuation? No. 25% stake. So valuation. So there's a lot of technical formulas, lot of jargons involved. I'll try to simplify as much as possible, but try to understand the core concept rather than understanding the formula, because you will get the formula anywhere. I'll just explain some of the best used methods. Now DCF is the OG. Okay, so a lot of students, they will understand the Gen Z lingo, the OG, the most trusted, most used method of valuation. So under DCF, every time there is talk about valuation, they'll always, first prefer a DCF. If that's possible, we'll go for a DCF. Okay, so that is, yeah. So this is a discounted cash flow method. Okay, so what it means that basically we are discounting all the future cash flows to the present value. Okay, so basically you are assessing the value of all your future cash flows at a present time using a discount rate, right? Is it clear? You want more explanation? Okay. Okay. So the core concept is the money worth today is more than the money worth tomorrow, right? And what we do is that first of all, we'll ask for the future cash flows for approximately 5 to 10 years. If the company has predictable, future cash flow projections, then it's simple, right? If it does not have, then we will have to look for other methods. But if the company do have a steady source of cash flows and it has plans for, later on to generate cash later on, then we can get that. And then what we'll do is that we'll also calculate a terminal value. Terminal value will mean that what will happen, how much of a cash the company will generate even if beyond projection. So let's say we are taking a projection of 5 years. Then what happens after 5 years? Then we will assume that after 5 years some amount will keep on pouring in. That's the terminal value. And very important term is WACC. So WACC means the weighted average cost of capital. How much are you paying to get that capital, whether it's equity or debt? Okay, so this becomes your discount rate, right? When you are discounting all the cash flows, this becomes your discount rate. So it involves the cost of debt adjusted for tax plus the cost of equity. Now, what will happen is that you will add up all your future cash flow, the projected cash flows, terminal value, discount it at the present value, and then you will sum up everything, which becomes your enterprise value less debt and cash, that is your equity value, divided by number of equity shares, you are getting the value of your company, right? This is the method, and this is the most used method. But if I told you about all the most of the concepts, I'll tell you about a few more terms which is generally used. So I told you about the free cash flows. This involves only the cash, not any non-cash expenses. I mean, like the depreciation or any kind of amortization, any kind of interest, anything of that sort. Then we talked about the weighted average cost of capital, which is approximately 15% or at times higher, 20-30%. And then there is beta. So beta is basically the risk factor. Okay, so risk factor means that when you're doing a business, you're taking a risk. So how much will that risk be? How much of a reward you will get from that risk, right? So generally generally the economy is growing by 6-7% based on the GDP growth rate. So how much if the market will reward you if you are taking a higher risk? So that is the beta component. Okay, then there is ERP. So beta is industry specific risk, and then ERP is your the geography where you are operating. Like for ERP for India, ERP for US will be different. So that is ERP. Then there is terminal value, like I told you, that we will assume that some amount of cash will keep on flowing till perpetuity. So that is terminal value, and that accounts for 60-70% of your valuation, right? So that has a major impact on your valuation. Perpetual growth rate is the factor at which you are going to grow your terminal value. So it's very nominal, 4-5%, 3%, right? So the terminal value will assume a growth rate that at this particular rate, the cash will keep on flowing. That is perpetual growth rate. And then there is DOLM. So if, like I think I missed explaining earlier, why do you need a valuation for an unlisted company? Anyone can explain? Raising funds, okay, but why do you need a valuation? Like for listed companies, you don't need a valuation. Have the prices already, in the market, it is already there. The price discovery has already happened. But for unlisted, since there is no ready market, so that means that you don't know what's the value of your company. So therefore, you need a valuer. Now, since this valuation is happening for the unlisted company, we're talking about the unlisted company, it means that there is some lack of liquidity, right? You can't sell it anywhere. You will have to find buyers, and then shareholders will have to agree to it, whether they want to sell it to that particular buyer or not, right? So that means that there is illiquidity in the shares, right? So therefore, we discount whatever equity value that we are getting by 20%, 30%, right? Now through this, you can tweak the valuation a lot. So if you are a founder, a valuer, if you have stake, you can, any of the values you are tweaking, it will change your valuation to a lot of extent, right? So if you want to, maybe to some extent increase the valuation or decrease the valuation, you can, slightly tweak some of the things. Of course, if you have inflated valuation, regulators will come to know. So you have to keep it in a, in a range. But all these factors will have lot of repercussion on the final valuation that you get. Now, I already spoke about there will be scenarios where this will not work, DCF will not work. So let's take an example of a very early stage startup. They have just started, they don't have these projections and all. They'll say, I don't know whether I'll generate cash or not, right? So then we will have to think about other methods. We'll talk about that, but still DCF is the most widely used, most common one, most trusted, right? Then there are other methods which can be used in combination of DCF. So I told you, like, there is a lot of judgment that the valuer needs to apply. So the business models have become such that it has become disruptive. It's very difficult to find a comparable company also in the market. Company which is doing same kind of business in the listed space or unlisted space. So in that situation, the valuer has to apply their judgment and maybe use combination of methods, use some weightage, give some weightage to maybe DCF 50% to 50% to some other method of valuation, right? So the valuer should not be restricting itself to a particular method or a guideline. He should look at it from the lens of, what's the future potential, what's the actual value of the company, right? Then comes the comparable company method, which you can consider when there is the DCF could not apply, right? So I'll take an analogy of real estate. Like if you are looking for a real estate, you go and look for a flat in a locality, let's say a 3 BHK flat, and then you say that this builder is offering at 80 lakhs, and in the same locality 3 BHK I'm getting for 60 lakhs. So it's not comparable, it should be somewhere around 60, 65. So that is comparable, because then you're comparing an apple to apple comparison, like similar kind of companies, which is known as the peer companies. So we have to identify certain peer companies, right? Some, mostly it is listed companies which is identified, and the manner in which you identify your peers will determine the valuation. So you will determine certain certain peer companies, and then you will arrive at a multiple which will give you the value of the company. So most used common multiples, let's say if you consider a revenue, then it's EV to sale or a price to sale. EV is enterprise value, which just discussed in the last slide. What is EV, right? So EV is mostly equity value of the company. Then there is enterprise by EBITDA. This is also widely used method, right? And then there is earnings ratio, that is price earning. Okay, I think there is some. Okay, so this is about the PE ratio, PE multiple. Okay, so we have heard a lot about PE multiples and PE ratios, price to earning. And the last one is price to book value. So book value is basically the rock bottom price of value of the assets and liabilities of the company based on the balance sheet. So this is used mostly for banks and financial institutions. Mostly these multiples will again depend on what kind of a matrix is applicable on your industry, right? So So if you are driven by sales, we will go for a revenue multiple. If the company is not profitable, then we have to go for revenue multiple, right? If your company is profitable, then we can look at a PE multiple. Okay, so it can be combination of multiple ratios also, right? So if we take an example here, the company revenue is 10 crores and industry average, the peer companies that you identify, it has a 5x multiple of revenue. So the value of your company will be 50 crores. So I was talking about the identification of peer companies. So peer companies will depend upon what geography you're operating in, whether it's India, US. You can't compare an Indian company with a US company, right? You also have to look at the size and the scale of the company, the kind of business they are doing, right? And then there, you have to look at the growth stage, whether you're not comparing a startup with a very matured kind of a industry, right? So you again have to apply based on your judgment. You will have to go through a lot of databases. The most common one which is used in the industry is Capital IQ, which gives you all the comparables and helps you identify the peer companies. Then it is yeah. So you only tell me now the scenarios where you would use a comparable or you would avoid a comparable. Anyone? I mean, it's there on the screen, shouldn't be on the screen. Calculate the value based on certain methods only. So then there is regulatory restriction, like NAV, the banks and the financial institutions, they will have to, necessarily they have to go with price to book value or a NAV. Then there are income tax compliances. I mean, there are certain sections which will ask you to do in a particular manner. They will, prescribe that this is the valuation method. You can't, use anything else. So then it becomes difficult to use comparables. Then I was talking about if it's a very early stage startup. So there are theoretical methods like, Burkus, there is VC method, there is scorecard method, okay. So these are not practically used as much, but you should know about it because we are talking about early stage startups where the projections are not available, a lot of data, a lot of probably financials are not available. Then what are the alternatives? So the first method is this one, Burkus, wherein what you do is that you assign a value to each criteria. So let's say for a prototype, you assign 25 crores or something, like good quality team, another 25. So you add that up and that's the value of your company. Okay, so it's a milestone based valuation method. Then there is a very popular VC Chicago method, wherein you determine the exit value of for the investor. Okay, so if the investor says that I want to exit at 20 crores, now what will be the value of the company now if now 10 years down the line if the company is going to grow at 10% CAGR. Okay, so you determine the exit value, you determine the growth rate, and then you work backwards towards the value of the company, right? The third one is scorecard method, wherein again it's kind of the Burkus only, but in scorecard what you do is that you derive a weighted average of all the parameters that is going to affect your company, and then you derive a multiple. So for pre-revenue startups, the traditional methods will not apply, and you can focus on other methods. The most conservative method would be a NAV. NAV would mean that you are pricing your equity at the rock bottom. It is the value as it is shown in the balance sheet. Assets minus liabilities at the balance sheet value. This is NAV. So at times, regulators need you to value at NAV because other methods will not give you, a picture which is true enough. So probably company wherein their liquidation cases going on, there's a banking or financial or insurance companies wherein there's a lot of transaction happening in cash, so we will not use DCF, right? So this is about the NAV, wherein we are valuing based on the book value. And then I'll talk a bit about option pricing. So I spoke about ESOPs, right, in the beginning of the session, that ESOPs are employee stock option plans, wherein you are offering equity to your employees at a discounted rate. It is not the share of the company, but it is backed by the share of the company. So when the employees will exercise, they will get the shares of the company. So it's slightly technical, but as a founder, as a student also, if you want to understand valuation, it is one of the things that you should be aware of, that how option pricing works. So options are a derivative. So it will derive its value from the company, the price of the equity shares. So the valuation that we spoke about, all the valuation method, it was to derive the equity value of the company. Now we are talking about how to derive the value of the options, right? So it will take, like there are multiple models, okay? There are option pricing models, one of which is again most commonly used, it is known as Black-Scholes. Okay, so it will take into account what is the value of the company at the time you are granting stock options, then what is the price at which you are offering those shares. Let's say value of the company is 120, you're offering at 100, volatility of peer companies is around 40, risk-free rate, as in if your the risk-free rate means the government bond rates, because without any risk, and what time the options are going to mature, when can you exercise. So then it will give you a value which is the value of these options, which is required to account for in the, like, based on the value, the accounting standards, you need to value, you need to account for based on the fair value of options. And then there are other use cases of this. I'll not get into that, but primarily it is like 3 valuation methods or models are used for valuation of options. First is Black-Scholes, the second one is binomial, and the third one is Monte Carlo. Out of which Monte Carlo is the most difficult one. It is a scenario based simulation that we do for random numbers. So it is like you are running a situation for 10,000 times random numbers, to understand the probability of happening of a situation. So where do we use this Monte Carlo? So what happens is that when your conditions are market linked, when your conditions for resting or exercise are linked to market, whether the prices will reach certain number or not, then in those cases we use Monte Carlo. Binomial for theoretical use, you can understand that it is generally used for a American kind of option wherein the expiry is not defined. So this, I understand this is quite technical, but I thought I'll just touch upon this. So the closing notes will be, the valuer is always the umpire, wherein he has to manage a lot of parties. He has to look at the founder's expectation. He has to, balance the regulatory compliances. He has to also, he has to also define a value for the company, which is everything for the founder, right? He has spent so much of time in the company, and it all boils down to that one figure, that is valuation. So with this, I'll just hand it over to Mahit to take the next session. Any questions?
To get the slide deck on the screen, just a small introduction. I'm Mahit Anand, partner at a law firm based in Bangalore called GameChanger Law Advisors. So I've been in practice for the last 11 years, and what I do, the primary area of work is corporate legal advisory is the primary service offerings that we do, and in that I handle private equity and venture capital investment transactions, both domestically and cross-border M&A and VC transactions as well. And to this, so today's session, okay, let me just remove my glass. Yeah, today's session that I'll be conducting is on decoding the legal mechanics of venture capital. All right. So before I start my session, just wanted to get a sense amongst the audience, who amongst you have started your own enterprise or planning on starting your own enterprise at some point in time? Okay, that's quite an encouraging number. And okay, so given that you guys are at a probably at a nascent stage or still at an idea stage, where financing probably comes at a much later point in time before you set your organization right, enter into strategic agreements or partnerships, try building your customer base, become more profitable, a more profitable enterprise, which will eventually grab the eyeballs of certain investors who are ready to cut a check for your company, right? So before you venture out and start your enterprise, I mean, of course, there are different ways and modes or nature or types of of enterprises that you might set up. You might look at setting up a sole proprietorship. You can look at setting up a partnership firm, an LLP, and then or a private limited company, which is the most ideal situation, which I'm going to explain to you. So typically, when it comes to availing financing for a startup, so, and the different types of financing that would essentially involve would be through equity shares, that is in consideration for the investments that you receive. You will be issuing equity shares to your investors. The other types of instruments would include your compulsorily convertible debentures, non-convertible debentures, loans, which is fairly simple, I mean, something that anyone would be privy to, and your preference stock. And the other new varieties of instruments are your convertible notes as well. Uh, Before I delve into the kinds of securities also, I think what's important is in terms of the legal structures of your enterprise. Now, some of you would have contemplated on starting up your organization as a sole proprietorship. While it is, I would say, sometime I would say it probably would be an obvious choice for anyone who's just starting out their enterprise on their own, or they probably would have found a friend of theirs with whom they probably the idea would have really struck a chord, and would have decided to set up this entity. You have no idea in terms of how to go about it. Like, should I set up a private limited company? Should I set up a sole proprietorship? What's the pros and cons of an LLP versus a partnership, etc. Right? Now, from an investment standpoint, it is always ideal to set up a private limited company. The simple reason being, there are shares involved. A company's shares are involved, and that's what an investor subscribes to. In a sole proprietorship, in a private limited company, a company is also treated as a separate legal entity, and the director and the founders are treated as a separate legal entity. This sort of brings in a level of accountability for the organizations as well. In a sole proprietorship, say if you are running the ship, if something goes down, you go down as well. And there is no governance involved. There is no monitoring involved. Then there is no form of accountability that's involved, because if it's a sole proprietorship, you're running your own show. So, essentially, there is no accountability, and there's no at times there's no transparency to an investor who probably would say that, hey, listen, fantastic idea. I'd like to put in about 10 lakhs into your organization. Fair enough. He puts 10 lakhs. I'm still a sole proprietorship. I end up burning the money. Probably I'm not able to achieve what that money was invested in, was given to me. I ended up achieving it. Now, what's the security the investor has? Nothing. He has absolutely no security in consideration for the investment that he's made. So, which is why, as you can see, it's not suitable for early stage startups, because there's a very limited financing options other than availing bank loans, which again would be a personal loan that you would be availing, because generally sole proprietorships, there's no requirement for you to register it as well, right? So the proprietor will be personally liable for any loan or any credit facility availed. Now, like that, you have something called as a one-person company, which again is not ideal for any startup, for an early stage startup also, because one-person company is pretty much like a private limited company. A private limited company, the statutory requirement is that you need to have 2 subscribers and 2 directors, out of whom 1 director should be of Indian origin, should be an Indian resident. Now, with a one-person company, it's essentially it is the same structure, but instead of 2 subscribers, you just have 1 subscriber. Then again, the entire owner's responsibility obligations will fall on that one person. Not something that would really interest an investor from the standpoint of ensuring stability with his investment and ensuring safeguarding his investment. That is something which a structure such as a one-person company often lacks. Partnership and limited liabilities. See, these organizations are also structured from a very different standpoint. Now, there are a lot of LLPs that are out there who are doing extremely well, extremely profitable. But their modus operandi is different. Now, typically, you see a lot of LLPs also say, we do see it in the consulting side of things, which is mostly from a services standpoint, right? And you probably would see a lot of LLPs from a manufacturing standpoint as well, because there is a limited partner is what you call, a designated partner is what you call as a person who comes along with you and you set up the LLP enterprise. Now, again, the liability here is also limited to each partner in terms of their personal contribution that they make here, all right? And similarly to the partnership firm also, what you see here, again, a partnership firm can only be registered. You know, it's unlike a private limited company, it's not registered with the Ministry of Corporate Affairs. Unlike an LLP, which is registered with the Ministry of Corporate Affairs as a legal entity. Then you have the private limited company, which is the most preferred type of an organization. And why it's preferred is the explanation that I gave you, that it allows for equity funding, debt funding, convertible notes, loans, and in some cases grants also. Some of you might be thinking, are for-profit companies allowed to avail grants? There are very few government recognized funds which can make grants to for-profit companies. That also is subject to the area in which they are working. Like if it is meant for social benefit or if it's creating any type of social impact, then certain grants are allowed, which will be accounted as grant, and of course you have certain tax exemptions attached to it. But net for a startup, the ideal form of entity would be a private limited company, simply because of the structure of it, to the governance that is involved around a private limited company. For example, if you set up a private limited company, you're required to hold a minimum of 4 board meetings. You're supposed to make an annual returns filing in terms of explaining what has transpired in your company over the year. And so that sort of gives a lot of visibility to the investors in terms of what's been happening with the organization, how are they going about their operations. And I think most importantly, and this is what I'll come to, and this is where the crux of my presentation is on, is essentially how investment transactions are structured with investors and what are the kind of instruments that they subscribe to. Initially, when PEVC investments started taking off here in India, mostly it was the equity investment that was happening at that point in time, equity and preference stock. This was in the erstwhile legislation as well, the Companies Act 1956. But now of late, there have been very interesting financing models that have come up, with the startup paradigm being shifted here in India in terms of how the startups, I mean, the kind of visibility the Indian startup ecosystem is garnering. Something like, say, for example, a convertible note. So this wasn't existent in India, at least till the last 3 to 4 years. But this is something which we borrowed from the Bay Area in San Francisco, which is startup hub of the world. So essentially, how a convertible note works versus an equity versus equity shares versus CCPS and CCDs. I'll explain it to you in the following slides. So yeah, so I've just sort of put down 4 common instruments that are typically issued by private limited companies in India to investors. First one is equity, of course, which is the most common one. Equity shares do carry a voting right attached to it. So if you hold an equity share, you get to vote in matters of the company. Is there a valuation required, which is what Neha was also explaining. So under the Companies Act, if a company has to issue shares to any new investors, the concept is called private placement of securities under the Companies Act. Every company is required to undertake a valuation basis which the shares will be issued to your investors. Different methods and methodologies of valuation is something which Neha sort of touched upon in her presentation. But then you have CCPS. Now what are CCPS? CCPS are essentially preferential stock, convertible preferential stock. So when CCPS are issued to you, you don't hold equity in the company. CCPS will convert into equity at a later point in time based on certain milestones that the company might have to achieve, or based on certain commercial terms that may be agreed between the investors and the founders. One common milestone or trigger event is such that today I put in 1 lakh rupees my investment, and in consideration for 1 lakh rupees I get 1000 CCPS. Now I'm still a preference stock holder. Now, when will these preference stock get converted to equity? Typically, the trigger event would be that if the company raises funds at, now today, say for example, I invested that 1 lakh rupees at a 10 lakh valuation. So 2 years down the line, if the company were to achieve a valuation of 20 lakh, of around 20 lakh rupees, at that point in time, my CCPS will get converted to such number of equity shares, and there will be a predetermined discount that I probably would have agreed. So typically, how it works is CCPS convert at a ratio of 1:1. That's typically the terms that are agreed. So today I subscribe to 1000 CCPS. Tomorrow, when my CCPS get converted, I'll end up having 1000 equity. But if the company is able to achieve a very high valuation, say in the next 2 years, then I would ideally like to avail a discount. Now you may ask, why is the discount? Why are you entitled to a discount? The reason being, I came into your company at a very early stage. I believed in you, I believed in your idea. It's just that you didn't have the funds for it. And I came in with the money. Along with money comes risks. So if you see the investment landscape typically here, how VC funds, venture capital funds operate. Venture capital funds, they make investments in about 10 companies. All they need is one company to do well. And typically that's how it works. Out of the 10 investments, 9 will tank. 9 probably they won't even be able to get 1x the returns. But there'll be just one company that really skyrockets and sort of balances out all the investments that they have made in all the other enterprises. So that's how it typically works. And why they opt for CCPS is because if you look at the IBC code here in our country, so that's the insolvency and bankruptcy code. Typically, when a liquidation event were to happen, now what I mean by a liquidation event is, say if the company is getting wound up, the company has undergone severe losses, it's getting wound up, or the company is getting acquired by someone else, and say it's getting acquired at a very high price because the company is doing well, and there is another entity who sees value in this organization where they feel that, okay, I'm going to acquire this entity and this is going to help me build my enterprise and take it to the next level. So what happens, which also would constitute a liquidity event. So what happens at that point in time is the person who holds preference stock will have preference over an equity shareholder in terms of distribution of dividends. What I mean by distribution of dividends is, today, say for example, you have invested 1 lakh rupees in my company and you hold, say, 100 shares. Tomorrow my company is getting acquired, and if you are going to hold 100 shares, probably the value of per share would be 1000 rupees. All right. But the price of the per share price has doubled because my company has done well and there is significant jump in the fair market value of my securities. So there is an upside to you because you put in the money for you put in that investment of 1 lakh, but in about 2 years you are getting 2 lakhs out of it, right? Now what happens at that point in time is, now there will be another person, say Neha would be holding equity shares in my company. You who will be holding CCPS will be paid out the money first before the proceeds come to Neha. So if you look at the hierarchy, typically first loans, debts, debt instruments, preferential stock, and then equity shares comes right at the bottom. So that's why investors are a bit savvy when it comes to subscribing to securities in private limited companies. Typically what they do is, if they want to subscribe to say 100 shares in a company, they subscribe to 95 CCPS and 5 equity. The reason being they take 5 equity just so that they have voting rights, because equity shares come with voting rights. Convertible preference shares, not unless it's contractually agreed. Voting rights typically, and if you see in your quasi-debt instruments such as CCDs and convertible note, statutorily there is no voting right attached to it at all, unless you sort of agree to it contractually. Valuation requirement is pretty much there for equity and CCPS. CCDs and convertible notes. So convertible note, what I was telling you. Interesting fact about convertible note. This again, which is a fairly recent introduction. By recent, I mean about it's been in existence for the last about 2 years, 2 to 3 years. So only a startup recognized the DPIIT can issue convertible notes in our country. Not any private limited company will be able to issue convertible notes. Only a DPIIT recognized startup can issue convertible notes. And there are certain criteria attached to it. A minimum of 25 lakhs has to be invested in a single tranche for an investor to subscribe to convertible note. And the duration for this convertible note to convert into equity shouldn't be later than 10 years. So within 10 years, you need to contractually agree that your convertible, yes. Early duration of conversion is simply because you really you won't be able to realize the value of your investment in such a short duration. So be it a sum of 25 lakh rupees, which is the minimum amount that you need to put into a company. See, there is an interest component also attached to a convertible note. Okay. See, what's a convertible note? It's a hybrid of a debt and equity instrument, right? So, and convertible notes when they are issued, now typically one, of course, a valuation report has to be obtained. Once and after issuance of equity shares to you, I'll have to file form PAS 3, which is called a return of allotment with the Ministry of Corporate Affairs, recording your investment. With a convertible note, only filing I'll have to do is with the RBI, which is called a convertible form CN1, which is just a form indicating that notes have been issued. The valuation part will come in when your notes get converted to equity. So till then, it will be still treated as a debt.
Okay, the time depends on the contract between the
Contract.
investor and
it's purely contractual, but statutorily there are prescribed duration. So it can't be before, it has to be within 10 years. It can't be beyond 10 years. So typically even for CCPS or CCD or any type of instrument, any convertible instrument that you may see in an investment transaction, the terms are usually predetermined between the investors and the founders. Statutorily, the duration is fairly long. For CCPS, the duration is 20 years, and for CCDs, it's 10. Typically, not many financial investors be invested in a company beyond 5 to 6 years. They look for an exit after 5 to 6 years. Either they get their 3x or 4x what they hope for, or settle at bare minimum, which is their 1x. Or worst case scenario, they might even lose their investment. So that's how it works. Yes. Ideally, it has to be there in your agreement, right? See, because offering a discount on the conversion of stock at the time of conversion is not something again statutorily mandated. These are terms that are typically agreed between investors and founders, but it has to be recorded either in your share subscription agreement or your shareholders agreement. Of course. So the thing is, the reason being, once your convertible preference, say your CCPS or CCD get converted to equity, the equity shareholders' shareholding in the company gets diluted. So tomorrow you don't want, say, the first investor to come and tell you, buddy, my investment in your company in 2025 was 14%, but you have issued stock and now it's come down to 12. There should be a reason. So there has to be majority acceptance of the terms. Correct. So typically, okay, yeah, this is where, okay, good question. And in terms of how these investment transactions are structured, I think that will be a good use of my time in terms of explaining this to you. Typically what happens is, See, there are different stages of fundraise, you know, right? So first is your friends and family round, then seed investment, angel investment, and then your series A, B, C, D, E, F goes on. Now, typically what happens, your friends and family round is not something that is heavily negotiated, because that's just your initial money that you're getting from your close personal network. They're okay with certain basic rights. Basic rights would be your information rights, where you'll inform your investors saying that I received this much money from you, this is what I'm utilizing your money for XYZ reason. They probably would have asked you for a return after 5 years or 6 years. I would like to see at least a 2x return on investment, or if not, worst case scenario, at least 1x I should get back. Typically, those are the basic rights that are agreed. Then there's something called as reserved matters. This is where it addresses your question. What investors typically ask for is, today I'm going to make an investment in your company, whatever be the size of the investment, and typically when it's the early stage investment, they don't hold beyond 5 to 6% of your company's total paid up share capital. What they'll say is, I'm going to put in the money. Say it'll be somewhere around the tune of 80 to 1.5 CR. That's typically the early stage investment, the check size. So what they say is, I would like to have a board seat, a non-executive board seat. That means I won't be taking shots on, calling the shots on day-to-day execution matters, but anything pertaining to my investment, which affects my investment, I want to be mindful of and I need to have a say in it. Typically, companies negotiate hard on this, saying that you're just putting in around 80 lakhs. My capital requirement is roughly around, say, 6 crores or 7 crores. Yours is a very small amount. I can't afford to give you a board seat because I'm looking at other investors who probably might come with a bigger check. But I'll offer you an observer seat. So by an observer is essentially that you know what the matters the board is discussing, but you do not have a vote in it. But there's this concept called affirmative voting rights or reserved matters. It's contained in a transaction document. That essentially gives the right to an investor to have a say in some of the critical actions of the company, which will have an impact, one, of course, on their shareholding, and two, also on the business of the entity. For example, the reserved matter, the clause or provision in the agreement would read in such a way that without obtaining the prior written consent of the investor, the company and the founders will not undertake the following actions. Some of these actions, and if I am representing the company, I would try to limit the list there. Simple reason being, I don't want to have some operational inflexibility in terms of going and asking the investors permission for each and everything that I need to do. Rather, give them the right. Of course, we'll have to be rational, right? Because we need money and these guys are coming with some sort of money, capital to us. So say if there is a change in the core business of the company. Now today you have started a particular business, say you're developing a dating app, okay, all right. And I see huge potential with you building a dating app, and I see that this is really going to rake in a lot of revenue. Tomorrow you decide, dating really is not my scene, I'll move into spirituality. I have no gyan about spirituality, and I don't know what the profit projections are. But I need to have a say in it, because I put in the money, you just can't willy-nilly change the nature of your business, right? So matters like that, so changes to the main objectives of the company. And if or if there is any promoter exit for reasons other than cost. See, because when an investor makes an investment, the investment is also based on the promoter's credibility. And suddenly tomorrow, if the promoter decides to walk away, the investor needs to have a say. Hey, listen, I put in the money, it has, and I'm looking at a 3-year investment. So at least till I am a shareholder in the company, you better be in the company. That's how investors negotiate for these terms. So when you put down these reserved matters, to answer your question, this is where contractually certain terms are agreed. It's not that investors will have a say on every matter that is being discussed or that's been undertaken by the company, but certain things that are that would sort of affect their shareholding is where they'll have a say. Now, if you go, if the company were to raise additional funds and go through Series B, C, and D sort of fundraise, then the reserved matters gets even more convoluted, and it's even more critical for an investor. Say, for example, if the company is raising an investment of, say, about 20 crores, there will be a reserved matter clause which says that without obtaining the prior approval of the investor, the company cannot avail loans from a bank or any or through any other credit facility that exceeds 8 crores. Why? Because that's almost close to half of the investment that the company has gotten. Now, if the company has gotten that sort of money, it shouldn't be a situation where they avail a loan and the money has been utilized to pay off the loan. The money is being utilized for their business plan, which will be discussed with the investors. So, which is why, if you guys have heard something called a legal due diligence, what an investor typically does on a company, this is the reason why. A legal due diligence exercise is conducted so that they understand what are the potential risks that are involved before I put in the money in the company. Now, typically okay, actually I think I'm jumping into a lot of things here. Yeah, so investment routes, these are pretty much made to new incoming shareholders or investors. Second one is the rights issue, when securities are being issued to existing shareholders. So today I make the investment in the company. Tomorrow, say 3 years down the line, I see there's value and I make the investment again. I'm already a shareholder. Now, since the company is going to issue shares to me at that point in time, it's called a rights issue. Next is a preferential allotment, where shares are being issued by the company to a preferred set of candidates or investors that they shortlist. So these are typically the stages of fundraise. Pre-seed, that's again personal savings, friends and family. That's ideally your first round of investments that you're able to raise. Next would be your seed round, your incubators, accelerator, grants, angel investors, like you have SGC step here in Mysore. There are a lot of other prominent incubation facilities that we work with. YSB in Bangalore, which sort of helps a lot of social impact based early stage startups who are working in the areas of climate, waste management, elevating poverty. And then you have early stage, that's essentially crowdfunding, angel investors, venture capitals. So these are all early VCs who come into play. Typically looking where you can see an investment to the tune of anywhere between 1 to 3 crores. And then you have the growth stage, where you have late stage venture capitalization, private equity and corporate venture funding, so which goes on to, which probably you would be reading in news and and essentially your startup section of Mint and Scroll and whatnot, where you'll be seeing $1 million of funds that are being pumped into organizations. And after that, the last bit is the exit, which is what the investors try to achieve out of their investments. So these are some of the stages in an investment transaction. So when you are ready to avail funding, first thing that you do is you draw up a term sheet. Now, a term sheet is not your definitive agreement. A term sheet is simply a document, a non-binding agreement, which you circulated to your investors. And you tell them, see, these are the terms basis which I would like to avail investment from your end, and in return, you will be given instruments in our company, either in the form of CCPS, equity, CCDs, convertible notes, so whatever it is. That's where the initial rounds of negotiations and discussions are going to happen between the founders and the investors, basis which your transaction documents will be structured, and your transactional documents are essentially your share subscription agreement and your shareholders agreement. So once your term sheet is being agreed and finalized, the investor is ready with his money, but he or she is not ready to put in the money yet, unless they do a due diligence. Now, we as lawyers, we conduct legal due diligences on companies, but typically before an investment is being made, say serial investors, they actually do a legal due diligence, financial due diligence, and a technical due diligence. So legal due diligence, okay, before I go to legal, financial is essentially look at the financials of the company, tax-related diligences, that essentially falls under your financial diligence bit. Technical diligences, if the company is heavy on in IP that they have created, which they own, you will have a patent lawyer or a trademark lawyer or copyright lawyer who will be looking into the filings that have been made with the concerned registry. It can be a patent registry, copyright registry, or the trademark registry, and get an understanding in terms of the validity in terms of the ownership over these proprietary technology that the company claims to have developed. So those are two things. Now, when it comes to legal due diligence, typically it's classified into around 6 to 7 heads. So when we conduct a legal due diligence exercise, we look at the company's compliances under the Companies Act. So that's your general corporate compliance is one that we see. Two is on their customer contracts and their vendor contracts to make sure that what they claim to say in terms of revenues is in line with all the customer agreements that they have executed. Thirdly is on, we also, as part of the legal diligence exercise, we also conduct an IP diligence. Pretty much what I explained to you about the technical diligence exercise is what is also included within this. 4 is litigation, to see if there has been any litigious actions against the company or the founders, or if they are a party to any such issues. And if so, what's the damage, potential damage that can be to the company. Then other one would be your real estate. What are the, essentially where is the company operating out of, and what are the properties that are held by the company, and is there a security attached to any of these properties? If so, and again, if there is any default here, what's the potential risk here? And then the labor compliance side of things. So labor compliance, again, that'll be a workshop on its own. So typically based on the number of employees that are there in the organization, there will be applicability of certain labor legislation. And of late, recently yesterday, the government is codifying the labor laws here in our country, which brings a lot of uniformity in terms of understanding the implications of the labor framework and regulations that are applicable to, it can be startups or even well-established enterprises working across multiple sectors. And then once the diligence exercise is completed, we come into the definitive agreements. So the next here between due diligence and the transaction, I'll just explain it to you in the form of an example. Now, say today I conducted a diligence exercise on your company, all right? And based on the review of the documents that you have shared, you would have raised funds from investors, say in the year 2023, all right? Now, I look at your investment document and I look at your statutory register, that's your register of members, where you would have included, say, Neha was the investor. So Neha would have made the investment in your company and her name is there in the register of members, whereas Neha has subscribed to X number of securities. Fine. But what the company hasn't done is you haven't filed a return of allotment with the Ministry of Corporate Affairs, which is an offense under the Companies Act. Every time you raise funds and you allot securities to an investor, you are supposed to make this form filing with the Ministry of Corporate Affairs called return of allotment, otherwise called as Form Pass 3. Now you haven't done it. Now if you look at the Companies Act, the fine that can be levied on you is up to the tune of 2 crores rupees. That's the penalty that you will be liable to pay. Now I am conducting the diligence on behalf of my investors. Now I see this issue. Now I will tell this to my investor. Say for example, if my investor is putting in 4 crore rupees, I'll tell them this is a high risk item because the company could be liable to pay close to 2 crore rupees, which is half your investment money. Now what should I do? I mean, I don't want to scare away the investor as well because there's a non-compliance. But also at the same point in time, you need to figure out a way in which you will be able to address this. What's the way you can address it? Now, for non-filing, there is also something known as compounding of offenses. So where, based on the number of days there has been a delay of you not filing Form Pass 3, there will be a fine, statutory fine and fee that would be levied on you, which will not be to the tune of 2 crores, of course, but that will be determined by the MCA. So what me as an investor counsel would tell you as a company is that, listen, rectify this. and I would call that as a condition precedent to closing. So that means before my investor puts in money in your organization, sort this issue out. If you don't, I'm not going to put in the money, plain and simple. Say for another example I'm going to give you. Say you're in a manufacturing sector and there is a particular type of patented technology that you have developed, which you claim is proprietary, it's nowhere there out in the market, and you do a fantastic presentation. I'm totally sold. I bring in my lawyers and then do the diligence. Now, when I look at your patent filings, it is still pending approval. Or probably there's this another part of the technology for which you haven't even made the application. So again, that's where I'll come and tell you, listen, I'm making the investment in your company because you sold me on the idea that you have built a fantastic technology. But if it's not registered, I really don't want to take the bet here. So I would recommend, why don't you register this patent and then come to me. That's when I'm going to make the investment. So there are a lot of these issues which you are able to unearth during a due diligence exercise. Some of them can be extremely small. Say, for example, like a registration under your Shops and Commercials Establishments Act. Now, in Karnataka, it's the most simplest registration that you can obtain under any labor law per se. So essentially, a Shops and Establishments registration is mandatory for any enterprise in Karnataka. It's again, the fees that you pay to get the registration certificate is based on the number of employees you have. If you are 0 to 50 employees, there is a particular fee that you need to pay, 50 to 100, etc. Now, say I do the diligence and I see that you do not have a Shops and Establishments registration. Now, what's the implication? Now, this is where it's very important for one to think practically. Because if you look at the strict sense of law, there are certain, like for non-filing of PAS 3, it can also lead to imprisonment of the founders. It doesn't mean that every time, because otherwise you probably, 60% of the founders in India would be in prison if that law was actually enforced. But that's not how it is. Typically the law is framed, but there is a way in which you can sort of redress any such non-compliance. So what happens here is, so essentially, say for a Shops and Establishments registration, it doesn't mean that because you haven't gotten the registration that your company ceases to exist. No. You would have paid 500 rupees for the registration. Now you probably would pay 600 rupees or 700 rupees. But I'm keen to make the investment as soon as possible. So I don't want to hold off on the investment because you don't have an SNE registration. I'll put in the money. I'll put in my investment, but within 30 days from the date of me making the investment, make sure that you do it. So that's called a condition subsequent to closing. Now there are certain action items that has to be done on closing which are mostly statutory in nature. That is passing a board resolution, shareholders resolution, filing these resolutions with the MC. So those are what you call as closing actions. Yeah, so these are some of the terms that are negotiated for in a term sheet. That includes what's the investment amount, nature of investment, that is whether it's equity, debt or convertible structure. 3, at what valuation are they coming in? Terms and conditions attached to the investment or instrument, those are essentially some of the rights, etc., that are given to the investors, which I've outlined there. Representations and warranties. Okay, this is another very important aspect pertaining to investment transaction. What you typically would have seen this term representations and warranties in many of these documents. What it essentially means is representations and warranties essentially means promises made by a founder to the investor. This is in layman language. So today, me as a company, I represent and warrant to you that the current shareholding structure of the company is accurate and the same is recorded with the MCA. So it is a promise and commitment which I'm making. So because when you make a representation on the share cap table is when I know कि when I make the investment, what will be my shareholding and to what extent the other shareholders holding in the company gets diluted. Similarly, there are multiple headings under which these reps and warranties are made. One can also be on intellectual property. 3 can be also on litigation. 4, say for example, the founders also explicitly making a rep and warranty stating that there has been no claim or action filed against him or her say on for any issues pertaining to harassment in office space or whatever it is. So these are certain reps and warranties, which is again, why is it important? Because, and these reps and warranties in transaction documents are extremely extensive. The simple reason being, you're getting a thorough commitment from the founders, basis which you are making the investment. And should there be a misrepresentation in any of these reps and warranties that are outlined, you as an investor will have the right to claim an indemnity from the founders. Now, what an indemnity is essentially making good a loss. Now, if any of these reps and warranties were to be misrepresented by the founders, because of which you end up, your investment gets adversely affected, then at that point in time, you have the right to claim for an indemnity so that you are put in the same place where you were before you made the investment. That's the, what do you say, the legal, a layman explanation of the legal concept of indemnification. Yeah, and this is what there is, diligence. Yeah, key terms in a share subscription agreement, as I just mentioned to you, reps and warranties, conditions precedents, conditions subsequent, disclosures. Disclosures are, say for example, if there are certain reps and warranties that have been requested. For example, if anyone's operating in the manufacturing sector, you guys would have engaged contract labor, right? Now, under the Contract Labor Act, you are required to obtain a registration as a principal employer as well. So the representation would be such that the company hereby represents and warrants that it is in compliance with all applicable labor legislations with respect to its business and operations, which also includes compliance under the Contract Labor Act. But they haven't obtained the registration as a principal employer for a particular contract manufacturing assignment. Now, if you haven't obtained, you can't do anything about it. The project's over. But that needs to be disclosed to the investor, which is what you call as disclosures. Because essentially, the deal is the investor is making an informed decision, knowing very well that, okay, there has been some non-compliance, but it's okay. I'm still ready to take the risk. But should this affect my investment, then I'm going to seek something known as a specific indemnity. So that's the implication of a legal due diligence exercise. It's just not a check the box exercise, but rather it has a ripple down implication on how your investment actually works. And key terms in a shareholders agreement. Now, these are typically the rights that are given to a shareholder. I'll quickly explain some of these to you. So, say for example, right of first refusal. A right of first refusal is simply that I'm an investor. Neha is the promoter in the company. So tomorrow, if Neha wants to, or any other shareholder in the company decides to transfer their shares to a third party, they should first make the offer to me. So that's the right of first. So then if I refuse, can they go and transfer the shares in the open market? Till then, they can't. So that's what you call as right of first refusal. Why is it sought for? Just to ensure that there is stability in terms of my shareholding in the company, and there are no third parties who come into play. And typically, there's a restriction on that as well, where it will be clearly stipulated that shares cannot be transferred to a direct competitor of the company. So you don't want a competition to be a shareholder in your organization. And then you have board seat, of course, investor reserved matters, which I explained to you at the beginning, tag along and drag along. So tag right is essentially what happens is today if, how it's typically structured. If the promoter group were to transfer their shareholding in the company, and such transfer would result in almost 50% of the shares of the total paid up capital of the company being transferred to a third party, then at that point in time, the investor will have the right to tag along with the promoters. Why is this right given? If the promoters are there themselves selling shares, which almost amounts to 51%, what business does the investor have there? He has nothing to do there. And if it's a formidable buyer, might as well. So which is why it's called tag along. So that means the investor tags along with the with the promoters, and they seek an exit. Drag along is the ultimate exit right exercised by an investor. So typically in an investment transaction, there are various exit options that are given. First one is an IPO. If the company fails to achieve an IPO, there's something called as a strategic sale or a third party sale, where the investor will identify a third party buyer who will be able to purchase the shares and give the investors the exit that they had sort of anticipated, typically 2x, 3x or whatever it is. So they will bring that investor and they try seeking an exit. But that also doesn't happen, where the investors aren't able to find a suitable investor who's ready to give them the exit that they desire. Then they wait it out for some more time. The last bit is drag along. So where at this point in time, even if the investors are not able to achieve say like a 3x return, but still they are getting 1x of what they have invested, they will find a buyer and they will drag even the promoters also to sell their shares in the company and move out. So this is like the most extreme right given to the investor. It doesn't mean that it's always been enforced. So drag along is a right. So I think we should understand this, that all of these are rights accorded. Doesn't mean that entitle them to immediately take action on it. Yes.
The right is based on the percentage of shareholding by the investor.
Yes. So that's how it's contractually agreed. Now, say for example, tomorrow you're raising funds where you need close to about say 10 crores for your company's operations. All right. You find a good VC fund who's ready to put in 9, nothing beyond 9. And I come in with a 1 crore check. I'll tell you, listen, I'm going to give you this 1 crore. So in total, you have 10 crores with you, and you are happy, and this works for your operations, etc. Can I also ask for a drag? I don't think so, because I've just put in a small portion of the investment. That is where you as a founder should negotiate. So you really shouldn't bend over backwards for your investors just because they're cutting the check for you. But you should also be smart enough to contractually negotiate what I can give you versus what I can give another investor. So most of the times, not all investors are on at the same level playing field. So today, if you are an early stage startup where you need some capital infusion, we all will do it. Say your friends and family around, etc. You will get a good sum of 1.5 CR. 5 years down the line, you have achieved a valuation of 150, 200 crores. You are earning revenues like crazy. Now the kind of investments that you are raking in is anything north of 30 to 40 crores. So would you give the same rights what you will be giving an investor who is coming with a 40 crore check versus me who had invested in you, say 5 lakh rupees at the time of incorporation? No, that's not how it works. So contractually, you work out the agreement, because this is how even investors are also bullish. You should also understand this, because even it's a risk on their part as well. So that's the sentiment where you need to appreciate and also need to respect and see how you can sort of draw a level playing field. It's not all the times investors are extremely bullish in terms of exercising a drag just so that they can get an exit out of it. Because should there be a situation where a drag is being exercised, that means the company really isn't doing well.
Is there any default rights for the investor, for example, of 10%, 25%, 50%, 75%?
No. There's nothing stipulated by law. It depends on how you draw up your contract.
Contractual.
It's purely contractual. So yeah, and anti-dilution are essentially, say today I subscribe to shares at 1 crore valuation, but tomorrow company is raising funds at a 50 lakh valuation. That means it's a down round. At that point in time, there are certain methodologies. It's called full ratchet or broad-based weighted average calculation, basis which additional shares will be given to me to ensure that my shareholding in the company doesn't get diluted extensively because the funds are being raised at a lower value. So these are some of the rights that are typically negotiated and what we do in most of these investment transactions. So yeah, I think that's me.
Much Neha and Mahit for the wonderful session today. I would request Mr. Ram to come and hand over the momentum to him.
I'm Nisha and I'm from GSS ITW Mysuru. Right now I attended the TiE session that was happening in November, and it was mainly on the two topics, that is valuation of startup and legal mechanisms of venture capital. It was a great insightful session for me because most of the valuation terms which we were unknown about how startups actually work came into my knowledge, and it was done by Neha ma'am. It was really very useful and helpful for the people who are actually want to start up their own business. And as per the legal mechanisms that was done by Mahit sir, it was also a very insightful one because many of the legal terms that we were unaware of and how the sole proprietor can face many problems were taught by him. So overall it was a great session for me. Thank you.
Hello, my name is Achalesh and I'm from 10X International School, Mysuru. So what I've learned today, I feel it will help me in my startup. So we have learned different methods on how to face startups because we might face a lot of issues in our startup. It might be a sole startup or it might be a group of startups. So with the methods and tools which I've learned today, it might help me, and I might also coordinate with our teachers on how to go about it, and it might really help me in my startup. So it was a very insightful session. Thank you.